Hi, I'm Tom Elliott, coming to you from 3AW Studios with another financial markets report for Hodges Real Estate. Firstly, locally, economic growth has been downgraded by the Reserve Bank. The forecast was still a rather bullish 4% per annum. The Reserve Bank has cut back the annual rate of growth for the coming year down to 3.25%. Secondly, and somewhat contradictory, the unemployment rate has actually fallen. October's data came out just a couple of days ago, and unemployment fell from 5.3 to 5.2%. So it's at odds with the cut in economic growth, but that is often the case with economic statistics. They don't always point in the same direction at the same time. Of course, on Melbourne Cup Day, the Reserve Bank came out and finally cut interest rates. Now, the big issue is rates have been cut just 0.25% from 4.75 to 4.5. 25 basis points is not enough really to change people's decision making. So the question that has to be asked is, will the Reserve Bank cut further? I think they will. All up, I think the Reserve Bank will cut rates 75 to 100 basis points over the next 6 months. And the other significant thing that's changed on the local scene is that finally the carbon tax has now been passed through both houses of Parliament, with the Senate approving it just a few days ago. It's no longer something that can be chopped and changed in the short term. It's going to come in. It might only be with us for a couple of years, but there it is. So we've had the carbon tax, changes in economic statistics, lots happening on the local front. Internationally, well, all sorts of things have happened, primarily in Europe. You've had the Greek Prime Minister, George Papandreou, he's resigned. Now the Italian Prime Minister, he's well known to most people, Silvio Berlusconi. Both these men were forced out because of their inability to do a deal on their country's respective debt problems. Europe, I think, is going to fall back into recession. I don't think there's anything else the rest of the world can do about it. So what does it mean for the financial markets? That's what we're here to talk about. Well, for share prices, not just here but overseas, it means volatility. Many people would say the best thing to do with shares right now is sell them, stick the money in the bank and just wait a few months, maybe the best part of a year. Not such silly advice. The Australian dollar also very volatile. It's dropped back to parity with the US, then it jumped back up to $1.08, now back down again. It is seen as what we call a risk asset. However, if commodity prices improve, probably the $8 will go back up. And the property market. Now, many of you watching this are investors or prospective investors in property, or maybe you're just looking to buy a house. What does this mean? Well, I think you've got to focus on two positive things, and I said these at the start of this talk. One is that the interest rates have come down. The other good thing is that the rate of unemployment also coming down, or at worst stabilising. That means that most people in Australia have jobs and their ability to service debt has actually just gone up. I think that will be positive for the property market. Having said that, in Melbourne at least at the moment, clearance rates seem to be stuck at between 50 and 55%, depending on which area you're in and which real estate agent you speak to. So overall, I'll just leave you with a bit of a thought. There was a recent survey done by The Economist, and it looked at what countries are the best in the world to live in, and Australia came a very close second only to Norway. I wouldn't want to live through one of Norway's winters. So that means we still live in the best country in the world. For that reason, we should all be very happy. I'm Tom Elliott. That was another financial markets report for Hodges Real Estate. I look forward to your company again, same time next month.